Welcome to the Cannabis Detector Podcast. No sugar, all spice. With the industry BS detector in residence, Kristen Yoder. This episode is part of a sponsored series brought to you in collaboration with Quiver Financial.
Hello, my Cannabis detectors. Thank you for joining me for another special episode in the All Things Green series, sponsored by Quiver Financial, and I am joined by Colby Mcfadden. He owns Quiver Financial. Thank you for joining me.
Hey, thanks for having me.
So let's do a brief recap on our previous episode, which was much more focused on investing in public cannabis companies. And then today we're going to be more focused on investing in private companies and what the differences are and the structures of them, et cetera.
Exactly.
So, well, let's get started. So on the public companies, we were talking about the press releases and how to differentiate them from being fluff or having substance, talking about RTOs, why companies are going to Canada instead of the US. Anything to add to that?
No, I think we covered a lot of stuff. So if anybody hasn't heard that, it would be worthwhile and going back and recapturing or re-listening to it because we covered a lot of background and a lot of basis that I think had a lot of value.
Yes, and I'm super excited to get into the private investing because that's a whole other ballgame and a much more risky, much more interesting, in my opinion, and much more fun, in my opinion, to work with these smaller companies. But again, the risk is very large. So can you talk about the difference between private and public?
Sure. So it's essentially the flip side. When we talked about the public markets, you're typically talking about a company that has already structured themselves, has a management team up and running, and once they're structured, they're going to public markets and getting public capital. On the private side, it's just like it sounds. A private company is privately owned. There's an owner or a group of owners. When you invest in a private company, at the end of the day, you have to remember that you're essentially investing in a management team or a group of people. And when investing in a private company, there's all kinds of sizes. So you've got venture capital, which would be investing in a privately held company that is a startup. And then there are private companies that have been around for many years. Like, for instance, Uber. Uber is a privately held company. Lyft, 23andMe. There's a lot of privately held companies that are very large and someday will become public companies. So the difference is just really, are they on a stock exchange or are they still held by individual or investors in essence?
For me, the difference would be, are they obsessed with profits for their shareholders or building up their company and serving their customers?
Yeah, that's an important, because once you go public, you have a different responsibility level from a fiduciary standpoint to your shareholders. And then at the end of the day, you got to worry about profits a lot more than you do as a private company. And what's happened in the cannabis space is a lot of people have been in this rush to go public. And the guys that I talk with and coach with, I always ask them, is that really what you want to do? Because the moment you go public, there's a whole nother level of compliance and legal you got to bring into the equation. And if the business is to scale, if you're making enough money and it's large enough, okay, that makes sense for some. But that's been a really big trend, especially in this space. The bigger trend across most industries has been companies staying private longer, so they didn't have to deal with those things. But in the cannabis space, it's been a little bit different. People have been a little bit in a bigger rush to go public.
Yeah, again, in my opinion, that's because all of these stock people, mining people, and other financial type people came in and convinced these companies to go public. And we'll see if that was a smart move. I really don't think it was for a lot of these companies because they weren't even solid in the first place, let alone having an infusion of capital to really drive it into the ground. But again, I am cynical. I don't invest because I'm cynical, so I might not be the best person to speak to it.
But I don't think you're too far off, though. I've met a lot of bankers that have had the and that their lead-in conversation with entrepreneurs is, "I'll raise you the capital, but you got to promise to go public within 18 months."
And why though? I mean, okay, is it purely for the stockholders or the shareholders? Is that why?
So as a banker, so bankers, we make our money doing a deal, right? So it's not like we're on a perpetual fee in banking. On the banking side, you get paid when you do a deal, and you get paid most when you take somebody through the whole private structure from being you usually aren't going to get involved in a friends and family round, but let's say somebody's at Series A and beyond. You make a lot of money taking them from there all the way through the IPO process. And for bankers, that's the payday. That's where you make the most money, because if you have warrants, the warrants, you just get a lot for a little in essence. And so it's, at the end of the day, you have to be careful, because is the drive greed based, money based, or is the drive truly based on whatever may be the purpose of the business?
Obviously, it's greed based. I mean, why else would you go public? You're not helping anybody but yourselves.
And that's why, as an investor in a private deal, you have to decide what kind of investor you want to be, because in some private deals, you're going to make an investment in the person and their dream, right? So I know some entrepreneurs that I've sat down with, and they said, "Hey, this is my dream. I'm building this. I'm a real big believer. I want to do it for 10 years, whatever it may be." So there's some investors that are big believers of investing in a person, and a lot of times maybe that's somebody that they were an entrepreneur, and at some point in the past somebody invested in them in that way. And then there's other investors that say, "Hey, you know what, people suck sometimes, and people are unpredictable. So yeah, while the people are important, the deal's more important, because I'm just looking for a flip. I'm looking for something that I can get in with, and they got a clear exit in 3 years."
Yeah, like a venture capitalist, basically.
Sure. So when you're private investing, you got to look at each deal kind of from that aspect as well.
I always tell companies, investors are like marriage with no love. Don't just jump into bed with anyone offering you money, because you will regret it if you don't find the right people that are investing for you or for your mission, or just to flip you and make some money. I think VCs are very dangerous for new companies, because new companies actually have to build themselves up, build up their customer base, build up whatever they're doing before you can go in and try and put them into hyperdrive to exit in 3 years.
Yes.
So I see that in California. I've seen investors run companies into the ground with their greed, because they didn't understand that it's like 2 years before you see a profit in California cannabis businesses, because of all the regulations and the compliance and having to put the money back into your company. So
Yeah.
it's different for each company, each purpose. But I think it's interesting that you're talking about with the bankers. I mean, why would any company go all the way through to public trading because a banker wants to get paid? Like, that doesn't make any sense, you know?
Okay, so I gave you that, so I gave you that as a friend, right? That now, as a banker, we don't approach a deal that way. As a banker, we approach it from the aspect of, "Hey, we get you the capital for what you need, and you're going to get rich along the process."
Gotcha.
Right.
Okay.
So yeah, I gave you the unspin version, but when you're entering into the deal, listen, the entrepreneur needs money,
Yes.
and every entrepreneur, when they're on this side, when they don't have the money and they need it, they are willing to look forward and say, "I don't care what the cost of capital is. It probably doesn't matter as long as I get it."
Oof, that's a mistake.
And that is a mistake, but you also have to put yourself in the entrepreneur's shoes, and know that those decisions get made. And that's why, as an investor in a private deal, you should only be an investor in private deals if you can afford the risk. And most private investing, and this kind of speaks to protecting yourself out there, most private investing is only appropriate for what they call accredited investors. Accredited investor is you got to have $1 million of liquid net worth. So not your home you live in. So it's got to be $1 million of liquid net worth and or an income over, I believe it's like $225,000 a year for the last handful of years. So if you don't fit that criteria, you're really not supposed to be invested in private deals. And quite honestly, the private deals aren't even really supposed to be soliciting you as an investor. Now, that has been completely thrown out in the cannabis space because everybody thinks they're going to get rich overnight and think every deal is going to be a success. And so you have that one fundamental, kind of cornerstone rule is probably not being observed all that well.
As someone who is very afraid of police and breaking the law, I have been afraid of acting in any sort of way of introducing companies seeking capital to investors because that's brokering. And I don't have the money to be fined by the SEC or something. So I've looked into it. I've heard from lawyers that that's illegal. You can't be brokering deals if you're not a licensed broker. So, I mean, but this is the cannabis industry. So there's so many other issues going on. I don't know if the SEC knows where to look at for going after all of these different broker or non-broker people. But anyways, I digress. Let's get back to the different types of private investing rounds, like the seed round, Series A, et cetera.
Sure. Yeah, so if you're an investor and somebody approaches you with a deal, whether it's in the cannabis space or not, and it's a private, that should be the number one question is, okay, what's the structure? Is it a private investment? And if the answer is yes, say, okay, where are they in the process? And what we mean by that is the very earliest round is going to be your friends and family round. And so you just got to think of this from the logic of how things happen in life. An entrepreneur has an idea or a product they want to bring to market. They're going to first use whatever money or capital that they may have to a certain point. They may set a boundary to that. And then after that, they're going to have to go to people who are close to them because it's an idea at most of the time at that level. It's very early stage. So you go out and you find money from friends and family because you don't have to be as structured with them. You don't need a prospectus, or a lot of times not, it's a handshake deal, which is, I wouldn't advise that. Anytime you go into business, you want as many of the terms laid out ahead of time. And but in friends and family rounds, it's going to be a little bit looser because you're dealing, like it says, with close people. And hopefully people that won't hate you at the next Christmas dinner when you lose their money. So the so if the money you get from friends and family round is enough and it takes the idea into fruition and you start to build a little bit of a team and maybe you start getting some sales, whatever it may be, then you start going. One process people can do is they can start doing what they call note rounds, where you offer investors to come in and they invest in a debt instrument like a convertible note where they earn some interest while they're waiting. And then they would convert to equity at some point in the future.
I thought that with the convertible note, the only reason it would go to equity is if they're unable to pay it back.
Yes, but see, most of what you have to understand, and this is where a lot of private investors make a mistake. They buy a convertible note, and the convertible note will have a due date. Let's say it's 2 years out, and so they, in their mind, they think to themselves, "Hey, in 2 years, I'm either going to get my money back or I'm going to convert to equity." But if you don't dig into the document, the subscription agreement, what they give you when you buy the note. You got to look, because in that note, most likely, most entrepreneurs know the chance of them having the money to pay everybody back in 2 or 3 years is unlikely without a liquidation event. So usually there's a clause in there that says, hey, at the discretion of the company, they can kick that maturity date, they can extend it. they have to notify you. You have to agree to it, but they can extend it. And so most of the time, convertible notes as venture capital, they never mature and pay in cash. They almost always either go to zero or they convert in the Series A round or Series C round.
Why I would think that investors would be bigger sharks on paperwork than entrepreneurs. Why would an investor invest with convertible notes then?
Sometimes it's just the vehicle available. So the person who's raising the capital, that's the vehicle that they offered, and there's no other choices. In most cases, these are people who aren't going to look that closely, or maybe in a venture capital deal, smaller check writers, maybe people who are writing $200,000 or $300,000 or $400,000. They're not funds or institutional based people who are really into the weeds and the details. And there again, it's when you're dealing with an entrepreneur, if you write a bigger check, you can dictate the terms, right? And so if an entrepreneur is looking for $1 million and you're willing and able to come in with 700,000 of it, well, you're going to be in a position where you can look at that entrepreneur and say, hey, I want to dictate what the terms are of this. So there's no one set structure. There's some flexibility there. But to answer your question is maybe that's the only option.
Then you'd really want to have to invest if you're willing to go with whatever option there is.
Yeah.
I would
And
think that it's an investor market, not an entrepreneur market, though.
Yes. Well, and most people that are looking for that are typically have a business background. I mean, they really, if you they're able to evaluate the aspects of the business, and they say, hey, I'm making a bet on this person, or I'm making a bet on that business, whatever it may be.
Gotcha. Okay. Well, so then what is a seed round versus a Series A?
So it's really more semantics than anything else. So when you get through friends and family, and if you haven't done a convertible note round and you just go into equity or vice versa, the first round of raising could be either Series Seed or Series A. If it's the very, 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 very first round of financing and you haven't done convertible notes, most likely you're going to term it Series Seed. And the reason the semantics sometimes matter is if your goal, when you're an entrepreneur and also an investor in an entrepreneur, one thing my father used to tell me a lot, you can do anything you want as long as you know your exit. As an investor, you need to know what they're thinking as their exit. As an entrepreneur, you need to think about what your backdoor exit is. And so there are if one of your options that you'd like to have in the future is further investment from a private equity group or a cannabis related fund, whatever it may be, well, there are many of those guys that by their mandate say, hey, we only invest in things that are Series A or later. So, there's some investors that don't mind getting involved very early when somebody's valuation is low. And there's some investors that are going to say, hey, listen, we don't deal with grooming people and raising it. We want to get started when those initial risks have gone away and the business is de-risked a certain amount.
So essentially that would be pre-revenue, post-revenue.
Yeah, exactly. You got it. So typically, so maybe a lot of guys will do Series Seed as their first round. So then that way, when they go to Series A, it's not considered Series B, and it gives them more flexibility to market to different potential investors. And then from there, the alphabet just graduates. So if you're an investor and somebody comes to you and says, hey, I'm doing my Series G round, okay, then they're pretty far down the path. There's no rhyme or reason to that. There's not good, there's not bad. But what you got to do every time that you're an investor into a private deal, if somebody's talking about Series Seed, Series A, Series B, any of that stuff, you really want to make sure that you get a copy of the cap table. And you want to make sure throughout your history of investing with that company, always ask for a cap table on a regular basis and save those things, because at the end of the day, if they do convert and you now have a big equity share in the business, or they do an IPO and you get a payday, that background, that back record of the cap table is the way you're really going to be able to backtrack and make sure you get what's owed to you.
Okay, so I'm thinking those are all very good points. And I think it's kind of confusing for me because I'm like, well, can you call something a Series R or a Series S if you're like 10 years old or something? Or like, where does the alphabet come from? But I don't even think that's relevant for the investors. So I'll skip that one. But we have like 10 minutes left, and I'm really interested in getting into doing due diligence and separating the hype from substance. And especially when it comes to um, companies like ArcView and other companies that introduce lots of entrepreneurs and new businesses to groups of investors.
Mm-hmm.
Obviously, they're the entrepreneurs, the companies are going to be a bunch of hype because usually they're not making revenue, right? It seems like they're pretty new, or they're not, making a ton of money, which is probably why they're going to these types of groups. But how can you tell as an investor in these sorts of groups? How can you tell who's good, who's not?
Well, that's a great question, because it's one of those things about having a little bit of a skill set and talent within yourself to be able to be able to make judgment calls on these things. But really, from the get go, there's some telltale things. Is one, you got to deal with people knowing what people are, and always remember that as is the inside, so is the outside, meaning that if you're going to be investing in somebody, you probably want to look for somebody who has organized themselves in a way and they have a team, that they know their own weaknesses, and because of that, they've surrounded themselves with a good number of people. So you can really tell a lot by a company or a group based on how deep that team is. If it's just one or two people, probably very early stage. If that team has now started to get built out to 5, 6 people, hey, then you know what? Not only probably have they been around for a while, but they've got good staying power because they've got that team. And as an investor in this space, I would highly recommend that people take the same approach and create their own team, because you're dealing at the end of the day in a commodity space, and there's a lot of moving parts to that, and there's a lot of things that are going to happen over the next 2 or 3 years as this industry gets normalized, and it's going to move at a much faster pace than any industry that we've seen before. And so you, as an investor, I think it's important to have your own team, that you need to go out and find people that can ask good questions and look at the financials, and you got to, it's better to have 3 or 4 people that are constantly looking at things as you're doing your due diligence, because that will help you see things that you may have missed.
Yeah, that's a great idea. Well, people like us, right? I mean, I've had clients that were ArcView members, and they had a lot of companies thrown at them. So they would bring back whatever companies they were interested in, tell me why, and then I would go through their decks or business
Mm-hmm.
plans or whatever and give my client a ton of questions to ask those companies, because I know what he should be looking for, especially in California companies, because although legalization passed last year, that doesn't mean all of the companies are up to snuff as legit companies and not California cannabis companies. And then you, as a wealth advisor, this is what we're here for, especially for these smaller investors. I think that's a great idea for them to have other people that bring their own strengths to the table. That would also lessen their risk in investment, right?
Yeah, and this is an unintended plug, but here's the reality: if you're going to take $50,000 or $100,000 or $200,000 or $500,000 of your hard-earned money and put it into a venture, if it costs you a couple $1,000s to have somebody who has some expertise look at it and give you some other viewpoints, that might be the best money you ever spent.
Absolutely. I tell people, if you can't afford me, you cannot afford to be in the cannabis industry.
Yeah, no, that's true. That's true.
I mean, yeah, I think this is one industry where you cannot be passive. You cannot just jump at whatever sounds good to you, because there are so many people with these fantastic ideas and absolutely terrible execution.
Yeah.
Or I remember we were talking personally, and you were saying how a good way to vet a team is to take them out for drinks.
Oh yeah, yeah, yeah. You definitely learn a lot when you take people out for drinks.
Yeah, so I mean, get into that, because I thought that was very interesting what you were saying, because it's a very good idea.
Well, there's just a lot of ways people act, and if they act in certain ways in their personal life, it's probably going to get reflected over into their business life. And this isn't a criticism in any way. It's just if people have consumption issues around a substance, then you've got to step back and say, okay, are they going to have troubles with self control around the checkbook? Or around their emotions when they have to make a decision. At the end of the day, most of the time, CEOs and entrepreneurs, the good CEOs and entrepreneurs, are incredibly good salesmen, which means sometimes you're getting sold. So I think just getting to know people on a personal level and making sure that there's also a little bit of a culture fit for you is a big trick. So, taking people out for a drink, there's a big difference between somebody who knows where their limits are and somebody who's, quickly over that limit and is surprised by it.
I think that's also especially applicable because this is an industry built off of a substance. So, I mean, I am a cannabis consumer. A lot of people are. I don't think whether or not the owner of a company is a cannabis consumer is nearly as questionable as whether or not they get trashed when you take them out for drinks.
Oh,
There's
there's a
a
very
slight
big
difference.
there's a very big difference.
Yeah.
Yeah, no, I agree, and I would say to you that in my years of experience in business, that cannabis consumption doesn't. I mean, that's one of the biggest stigmas that was ever out there, is that it would stunt performance in any way or keep people from being motivated. Quite the opposite when it comes to entrepreneurs and CEOs. Most of the time, they're so driven and so ADD that the substance actually helps to just take enough edge off so they can stay focused.
Take a chill pill.
Yep.
Yeah, I mean, hey, that's why they got into business in the first place. Just
Yep.
kidding. Well, so we are about out of time. Is there anything else you would like to add?
No, I would just say that in the private side, for people that are out there looking, if you're thinking about the pluses and minuses, I would say that the one thing about to focus on the private side is there's some areas of investing in cannabis that you don't have much exposure in the public space. So, for instance, when it comes to testing, there's really not a public company that you can invest in the testing space. When it comes to either cannabis tourism or events, there's really not a public option there. Same with a lot of ag tech. If you're trying to play a local, you want to be, really involved in the cultivation investment. Well, here in the U.S., there really isn't a public play for that. So for a lot of people who want to play in the cannabis space, they have to look private. And so this, all these things we've talked about, especially if you want to focus in those particular areas, you've got to really emphasize on creating that team for you as you go out there and look at these things, because in the private space, it is easier for the snakes and vipers to live in the grass.
Absolutely. How can people find you?
We're on the internet. Quiverfinancial.com would be the most convenient way to do it.
Okay, great. I highly recommend that people reach out to you, because you've been incredibly helpful for me to understanding a lot of things about investing, because I'm not an investor whatsoever, but I do talk to entrepreneurs all the time. And as the BS detector, I'm just trying to protect people from each other. So I really appreciate your information. And I look forward to our third episode where we touch on the effects of legalization on a national level and globalization and what that can do for our industry. So stay tuned, everybody, and thank you for tuning in. We will talk to you soon.
Great. Thank you.
If you've enjoyed this episode, please be sure to subscribe and leave a review on your favorite podcast host. It really helps us get the truth out to a larger audience. You can follow us on Instagram at CannabiSPod and on LinkedIn at the Cannabis Detector. Show notes and links to articles referenced in this episode are available on our website, cannabispod.com. Is there a topic you want to hear, or do you have some BS you'd like to tell our audience? Send us a message on Instagram at CannabisPod. Stay skeptical.